Hi guys. Today we will analyze Rio Tinto stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock is an average performer in the overall market. Both the short-term and long-term trends are positive. Support levels are around $76.70 and $72. Next support levels are around $62.20 and $60. Resistance level is around $82. Next resistance level is around $86.50. In the last month the stock has been trading between $67.50 and $82.80 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 5.2 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 14% per year, for last 5 years. We see that the average profit margin of the stock has been around 26% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 91% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Rio Tinto Company: bad, average, and good. First scenario. Rio Tinto will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, -4%. Future profit margin would be low, 20%. Future free cash flow to net income rate would be low, 60%. In this case, the fair value of the stock today would be $94. Second scenario. Rio Tinto will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, -2%. Future profit margin would be average, 22%. Future free cash flow to net income rate would be average, 70%. In this case, the fair value of the stock today would be $130. Third scenario. Rio Tinto will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 0%. Future profit margin would be high, 24%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $176. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 12.95. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Rio Tinto, analysts forecast growth rate around -5% per year in next 5 years, and future P/E around 7. Again, I will use 3 different scenarios for Rio Tinto Company: bad, average, and good. First scenario. Rio Tinto will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, -4%. Future P/E would be low, 7. In this case, the fair value of the stock today would be $27. Second scenario. Rio Tinto will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, -2%. Future PE would be average, 10. In this case, the fair value of the stock today would be $46. Third scenario. Rio Tinto will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 0%. Future PE would be high, 13. In this case, the fair value of the stock today would be $71. As you can see, today the stock is a little bit overvalued, $80, even if we expect the company's high performance in future. The fundamentals are great. And the stock looks almost fairly priced. However, there are signs of a wider economic slowdown in both the US and China. Based on estimates for the next 5 years, the company will show a negative growth in revenue, -5% on average per year. This is not good. It's a highly cyclical stock. In times of rising interest rates, cyclical stocks perform poorly. I like the stock, but I will definitely not buy it in 2022. It's just an opportunity cost. There are many other good stocks on sale now. Company strengths. Based in London, Rio Tinto is a leading global mining and metals group. The company's primary product groups are iron ore, aluminum, copper, gold, uranium, and diamonds and minerals. The company has strengthened its operating performance and balance sheet by cutting costs and selling non-core assets. It also continues to return cash to shareholders through dividend increases. The company has traditionally performed well during difficult economic times, and it has strong long-term growth opportunities. Copper and iron ore costs are expected to rise from 2021. The company is growing its business and pursuing environmental initiatives through the following partnerships: InoBat, lithium battery manufacturing and recycling; Comptech, to design new aluminum alloys for use in electric vehicles and 5G antennas; Komatsu, to implement zero-emission mining haulage solutions, including haul trucks; Caterpillar, to use autonomous, zero-emissions trucks at mining operations in Australia. Rio also announced a partnership with Sumitomo to study the construction of a hydrogen pilot plant in Gladstone, Australia. Rio also approved the construction of a new huge solar farm and battery storage facility at Weipa, Australia. The company's return on assets of 21% and return on equity of 41% are amongst the best returns of the industry. Its profit margin of 33% is amongst the best returns in the industry. Rio Tinto has more cash than its total debt. The company is financially healthy and should not expect problems in meeting its short-term obligations. Rio has a yearly dividend yield of 9.84%, which is a nice return. The company pays regular dividends twice a year, in April and September, and occasionally pays a special dividend. Risks. The greatest risk for Rio Tinto investors is the cyclicality of the company's business, as economic downturns can sharply lower demand and pricing for iron ore, copper, and other commodities. In times of rising interest rates, cyclical stocks perform poorly. The company is global, and faces a host of different regulatory environments. It has also faced public and shareholder outcry due to its destruction of sacred Aboriginal sites in Australia, supply risk from the Russia-Ukraine conflict, and prolonged COVID-19 outbreak. The company paid too much for acquisitions and expanded when it was expensive, permanently diluting returns. Mining is cyclical and capital-intensive, so the missteps could repeat. Rio Tinto is being viewed as a high-yielding income stock, but resource companies can often be unreliable dividend payers. 72% of the earnings are spent on the dividend by Rio. This is not a very sustainable payout ratio. Keep an eye on it. Management's target payout ratio is 60% of underlying earnings in the next 3 years. There are signs of a wider economic slowdown in both the US and China. Based on estimates for the next 5 years, the company will show a negative growth in revenue. The revenue will decrease by -5% on average per year. In the coming 5 years, the earnings per share will decrease by -15% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.